Good morning. I've decided to start making a vlog about amateur stock trading. This vlog is going to be targeted towards people who uh, know little to know nothing about the stock market. Um, it should be for people who want to start trading recreationally. So, in other words, without high hopes of being rich. Um, but it would have a higher return than investing in uh, scratchers tickets or the lottery, the Powerball. Um, when you go down and buy a lottery ticket or a scratcher, your odds are extremely low, especially if you buy them every week. Your odds are extremely low of ever in your lifetime making any profit off of that. Whereas if you're trading in the stock market, even as an amateur with no experience, your odds are higher. But as an amateur with no experience and no education, formal education or anything like that, you're not likely to be rich, but you're more likely than if you were to invest that money in the Powerball. So that's the type of people I'm targeting. Someone that wants to just tinker around with it. If you would like to actually make some decent returns and you're not confident that you could do it yourself and you don't have enough experience, I highly recommend a financial advisor. You like my hair, by the way? That's the ADD in me. Anyway, I would highly recommend a financial advisor. And there's different types of financial advisors out there. I might, in one of my video vlogs, talk about that. Um, so I think I'm going to have several vlogs that talk about everything, and it's just going to touch up on everything and give examples and how to do it. Um, Starting out with the most basic, what is a stock? Um, what is an option? Um, Different things like that. So you can get into it and start tinkering around with it with your favorite trading company or trading app. And if you end up making a 1% gain on the stuff that you're investing, you've done better than scratchers tickets. Um, but maybe you get pretty good at it and you're making 10 or 20% per year off the money that you invested, which is really good. That's you know that's probably what you would expect to get from like a financial advisor, somewhere between it would grow faster than the rate of inflation, which will kind of touch on the high level of what inflation is and how that affects your investments as well. So, without further ado, let's go ahead and get into it. And um, if you like what you're seeing, go ahead and subscribe, and I'll keep these vlogs going. Okay. So let's start with the most basic. Uh, what is a stock, and why do people invest in stocks? You know, Obviously we know the second part of that question is they want to make money. Okay, but what is it that makes them think that they're going to make money? So let's break that down a little bit. So I've got I'm a Gen X guy. I've got my whiteboard. I'm a whiteboard fanatic, uh, and I'm going to try and draw some of this out to you. So, what is a stock? Let's take a step back. What is a business? A business is something that produces money, uh, right? So it's a service or a product or something like that someone is selling or charging money for. And it's bringing in money. And the ideal is that the money put into that business is less than the money being returned on that business. So if I'm a business owner, I would hope that I could put in $0 and get back $100, right? But that's not realistic. In order to make money, and everybody's heard this before, in order to make money, you need money, right? So there are different strategies to getting money. One of them is I inherited it. Well, now I have money, and there's you know, a lot of people out there with a lot of money to invest, and they do that. In some cases, that's where it's advantageous to be born in a rich family. Another strategy is taking a loan from a bank or from a friend or from, you know, the, some shifty guy that'll beat you up if you don't pay it back real soon. But it's a loan. And you would take that loan and you would put it into your company and buy the things that you need to run your company. If I'm selling dog clothing, well, I need to buy the dog clothing in order to sell the dog clothing for a profit, right? So that expense, that capital, is necessary in just about 100% of every business. If that expense wasn't there, then you'd be spending zero and making a lot, and everybody would be in that business, right? That's just not realistic. So with a loan, it's expected that you would pay back that loan in a certain period of time. So if you're going to take the loan, you're highly confident that you'll be able to make a profit on that loan or on that business in order to pay back your loan, right? So me as a business owner, I am confident in the potential of that business, okay? And the reason I'm confident on it is, I believe in this product. I know I have a strategy on how to make money, okay? So another way to raise revenue for a company is to split your company up and let others share in the ownership of that company, okay? So let me get to the whiteboard and let's create a company called Pretty Puppy. Let's see. How about just prettypuppyclothes.com or Pretty Puppy Clothes? Okay. Whatever. Acme. I don't know. Some business name. All right. So. Is that big enough? Let's see here. I think so. We're good. Pretty Puppy clothing. Okay. And let's say I want to make this a publicly traded company. In other words, I own it 100% of this company right now. Okay. And I want to take and split that into two, and I want to own 50% of it. And I want to sell half of my company to someone else. Okay? So let's just say that the current company's value, in other words, if you think of a company as something like let's just say a car. I want to sell my car, okay? I think the fair trade value of my car is $1,000, okay? So if I have a buyer that believes that car is worth $1,000, they'll buy it, or they'll try to negotiate a lower price. If I have a buyer that believes that that car is going to increase in value over time, in other words, become a collector's item, maybe they'd be willing to negotiate a little bit up if they feel like somebody else is going to beat that price out. Okay, so that's what you call demand and supply. We'll say that for another video. So a business works the same way. Think of a business like a car. If I want to sell a part of my business, first of all, it's going to have an expected trade value or expected selling value. So let's just say my company is worth $1,000. Small company, right? If I sold it for what its market value is, then I could sell half of it for $500, right? But what if I've got 10 people that want to buy that 50% of my stock, and they really believe that in a year from now it's going to be worth 20% more, or $1,200 in a year, right? So now you've got 10 people competing to buy that 50% share of my stock, and they're going to pay a little bit more than that $500. So let's say it's currently valued at $1,000. Okay? $1,000. And I want to keep 50% for myself, so it is so that I maintain control of the company, right? But let's say this other half I split into two more halves. So this is 25%, and this is 25%. So now there are 1, 2, 3, 4 shares of my company. All right, I own 2 of them, and I want to sell these 2. Okay, right now it's valued at $1,000. So now I've got 10 people over here. It's not a boy. That want to buy one of these shares. So this person might offer. So, let me back up a little bit. If this whole company is worth $1,000, well, then this 50% is worth $500, and this 25% is worth $250, and this 25% is worth $250. But these 2 users over here highly believe that in a year from now, this company is going to be worth $1,200. Okay? In 1 year, they believe it's going to be worth $1,200. Okay? So half of $1,200, half of $1,200 is $600, and half of that is $300. So they believe in 1 year that this stock is going to increase to $300. Well, that's a really good increase in profit, right? That's 20%. So what they will do is they will try and buy this for, they'll compete to buy this. They probably won't pay more than $300 because they want to try and make a 20% profit, right? So maybe they'll pay $275, and when it becomes $300, they'll still have made a 10% profit. Okay, that's still a really good profit, way better than, but realistically, I mean, it could be, you see companies going out there and in 1 year going up 50 and 60 and 70%. And that, what the reason that's happening is because these guys right here are competing because they believe strongly that this company is going to do good. Okay, so they're willing to invest more than the current market value in order to be there when that company's value goes up. And whatever they invested, in this case, maybe they pay 275. If it goes up to 300, then they made some money. So that's the concept of why would I sell part of my company to someone else. What I'm doing is I am creating an opportunity for money. Someone just went out and bought my stock for 275, 1/4 of my company for 275 when it's really only worth currently 250. I've just raised $25 in investment from the people that are buying this for 275. So now my company has the ability to use that money to grow, right? So that's the concept of stocks. Why do companies sell part of their company? Its bottom line is to raise money so that it can grow. Now there are different types of companies where, you know, they're not trying so much to grow, but they're just trying to uh, maintain a steady course, and we'll get into that later. But ultimately, a company's goal is to have cash or money to uh, use on expenses to make the company run better. So I'll stop there, and I'll pick up maybe another topic next time. And I hope this made some sense to you about uh, what it means when I am buying a stock, and what I actually doing when I buy that stock. Okay. So maybe next time what I'll talk about is a little bit more deep dive into some different terms that you might have heard before, like um, well, we'll figure that out, but I'll dive deeper as I go. All right.